Hello dear algorithms traders, on the way to becoming a successful trader. We meet many people on the internet who have formed their own opinions about trading. In principle, that would also be completely fine if it is not a matter of money making, rip-off, or vanity. Some traders claim that trading is the easiest thing in the world. They don't understand why many traders think or act in such a complicated way. Traders who have been trying to break even for many years feel like underdogs or losers because it seems so easy for others. In today's post, we examine the extent to which trading can actually be classified as easy and whether an above-average return can be achieved with little effort. When browsing the various trading forums, one often gets the impression that over 80% of all traders are successful there. Incredible strategies and huge profits are published daily. Some traders might indeed get an inferiority complex. But if you then go to the broker's website, there is a legally required sentence as to what percentage of small investors lose their money with this broker. According to the brokers, on average over 80% of small investors lose their money, although I personally believe that the numbers are significantly higher because they are partly embellished. To make up an 80% loss, you need to post 400% gains to get back where you started. If trading really is that easy, why do over 80% lose their money? If we take the trouble to analyze the trading floors of the big players, we find that the big players employ thousands of traders, analysts, and programmers. They invest billions of dollars in the latest technology, microwaves, to improve their latency and use the fastest servers that are in close proximity to the exchange. In order to use the best strategies, physicists, IT specialists, and quants are employed to program special algorithms. If trading really is that simple, why are the big players investing billions of dollars in technology, analysts, and traders? In Germany, Austria, and Switzerland, 10,000 traders work in the futures market. 10% make profits, 5% make a living from it, and 90% suffer losses. The values refer to the last 3 years, since the Forex and futures market cumulatively achieved the same results. 10% of future traders work in the area of software, indicators, copy or foreign money trading or as a trading coach. If we now assume that a trading coach is profitable, then they would be the only winners in the futures market. That means there wouldn't be a single retailer who isn't a trading coach and making a profit. We all know that the profit and loss distribution looks just as bad for the trading coaches as it does for future traders who are not trading coaches. So, there are 100 trading coaches who make profits, 50 make a living from it, and 900 trading coaches lose money in trading. This means that 90% of all trainers are fake coaches. If trading really is that simple, why are there trading coaches that so many students fall for daily? Then trading would be easy to learn. Here we see a professional trader with 8 years of experience making €120,000 net per year. The trader trades 100 hours per month, earns €14,000 before taxes, has family insurance, has no costs for self-employment or advertising, pays €4,000 in capital gains tax, and thus comes to a net of €10,000. A smaller trading coach earns €10,000 in 100 hours. After deducting his costs, he is left with €6,000, minus taxes he earns €4,500 net. This means that the professional trader earns twice as much as the trading coach or would only have to work half to earn the same amount. If trading really is that easy, why are there trading coaches trading for half the hourly wage? Now some will say, well, there are a few trading coaches who even drive a Lambo. That's true, but then we would have to rephrase the question. If trading really is that easy, why are there only trading coaches who can afford a Lambo? Then they wouldn't have students because trading is so easy. In fact, for the majority, trading seems anything but easy. Of course, there are always exceptional cases that see things differently and say, what do you want? It's all easy, but most of them have been trading for decades. Let's talk probability and chance. If one speaks of probabilities, this always occurs in connection with some event that can occur under certain conditions but does not have to occur, i.e., for which several outcomes are possible. Such events are called random events. Causality is the relationship between cause and effect. It concerns the sequence of events and states that are related to one another. We have talked many times about the cause of price movement down are market sell orders running into limit buy orders and the cause of price movement up are market buy and limit sell orders. The effect or result is thus the price and the spread. However, the DOM is not a monocausal event, but a multicausal event, since there are several causes at play that interact differently. The background is that every market or limit order can have different strengths within milliseconds, the sequence of which cannot be predicted. There are theoretically infinite possibilities for a movement sequence within a fixed period of time. In 2021, I analyzed 65,000 candles to identify patterns. First, it was about finding candles that included an equal price structure. Since I was not able to prove this, I concentrated on equal sizes within a candle. I did find 12 clear matches in the 65,000 candlesticks and checked if there were any clear patterns in the following 6 candlesticks. That could be answered with a clear no. This means the candle is a purely random product created from price and time. Thus, there are no clear subsequent patterns in the 25 million candles in M1. But the frightening thing is that this applies to the volume, footprint charts, imbalance, all indicators, but also to the DOM and the TNS list. So, whatever the realist, the dreamer, or the trading coach sees on his chart is just a random result. However, you cannot create future derivations that would be demonstrably profitable from a coincidence. Therefore, a trader must work with probabilities to increase his chances. Let's look at a few examples. Most markets have the awkward quirk that price moves sideways 70% of the time. Only in 30% of the cases do longer upward or downward movements occur. Equilibrium can be predicted 80% of the time and an outbreak only 20% of the time. In 33% of the cases, stronger candles form in the Euro-US dollar and only in 9% of the cases larger breakout candles. So, it is easier to trade within an equilibrium than to bet on a breakout. A trader looking to make money from repeatable trades should also bet on events that are more likely to occur. The fact that down moves are 29 to 39% faster can give a short trader up to 38% more return. Do the big players react to news, or is it the other way around? Well, the market makes the news and not the news makes the market. However, this often results in high volatility, which leads to high losses. The imbalance between retailers and big players in the market arises due to the high capital, but also due to significantly poorer technology. 80% of all traders trade with a laptop or mobile phone and thus with bad latency times. Under certain circumstances, this can lead to a retailer entering the market half a second later. In the event of an outbreak in particular, this can mean high losses. The pip value per minute is also a decisive factor. The longer a trader is in the trade, the higher his risk is automatically. Likewise, volatility is an underestimated risk factor. Of course, high volatility means that the trader is faster to profit. However, since 80% of all traders lose, high volatility is not particularly helpful. Let's take a look at the impact that high volatility can have. We complete 10 trades and stay in the trade for 3 minutes each time with a loss rate of 80%. We lose 32 pips in the Euro-US dollar and as much as 91 pips in the Pound Australian dollar. With a win rate of 70%, we achieve a profit of 13 pips in Euro-US dollars and 29 pips in Pound Australian dollars. The 10 trades reach the following values in 10 minutes, and these values in 60 minutes. Losses in GPBAUD are 2.84 times higher than in Eurist, but at the same time profits are significantly lower. The longer the trade lasts, the more the GPBAUD aligns itself with the Euro-US dollar. Losses are 2.46 times higher in Euro-US dollars, and even 3.14 times higher in GPBAUD. Only after 1 hour are both almost balanced. In this case, this means that the Euro/US dollar is particularly interesting in the short term, the GPBAUD more in the long term. But honestly, which trader makes concrete comparisons on exactly this? Another important probability factor lies in the win rate, which is decisive for the trader tax. With a win rate of 75%, the trader tax is just 33%. Clever money management also influences the probability factors enormously. Especially as a beginner, you can lose a lot of money. To limit losses, trade the smallest contracts possible until breaking even. After that, you can scale up your winnings. Likewise, one should ask the question why one should wait 138 seconds in AUD/NZD to reach the break-even point when it is almost 2 minutes faster in Euro/US dollar. You can find these spreadsheets on my German blog at Forex Factory. In this video, you will get all information about it. The most important step for a trader is to understand how the big players are trading in a given asset. You should be able to read the chart like a musician reads his sheet music. Even for a lion, the hunt for a gazelle is always marked by different coincidences, since he never knows in which direction the gazelle will run. If trading were that easy, there probably weren't insurance agents, politicians, influencers, or trading coaches, then probably everyone would be a trader. I might have been able to show you today that trading is anything but easy. Of course, there are traders who can trade successfully with an indicator. That's not because trading is easy, it's because he's accumulated many thousands of hours of experience in the field over 7 or 8 years. But the most important thing to understand is that all of these things that we see on the price chart do not have any patterns that can be implemented for profitable trading. This is exactly why, many years ago, I focused on the algorithms that we will talk about in my next posts. I wish you a successful trading week and look forward to seeing you here again soon. Best regards, Michael.